Anyway, in this lecture, I wanted to talk. I have 5 levels of regulation that I want to talk about. So, first one is the lowest level. It's within the firm, and maybe people don't always talk about that as regulation, but I'm going to count that. Firms set up their own rules. There's no government involved. This is just internal. Then there's trade groups, all right, where a group of firms will get together and form a trade organization or a self-regulatory organization, and they will decide on rules among them that will... Then there's local government. That would be at the city or province or state level. And then there's national. And you can see where I'm heading to international. So those are the 5 kinds of regulation. And I think that the oldest are the ones at the top of the group. And as time moves on, we're becoming more and more broad in geographical scope. So I'm preserving international regulation for the end of this lecture. So let me start with number 1, which is the within firm regulation. And I thought I would start by just, we've talked about this before, about the modern corporation as having a board of directors. And they could be called the board of regulators. Nobody calls them that, but I think that they look a lot like regulators, but they're not imposed by the government. Remember I said that a team playing a sport wants a referee. So companies want somebody imposing some kind of standards on them as a group. So companies have boards of directors. Now, in most companies, they have both inside directors who work for the firm, and they have outside directors who have nothing to do with the firm, except that they're on the board of directors. I think that it's really the outside directors that make the board of directors into a sort of regulator. In the last lecture, I was talking about how people are different, and some people show more character than others. That's a problem, a fundamental problem in human society. A lot of the people who rank very low on character end up in jail, unfortunately. But most of the time, we don't want them in jail, but we can't put them in positions of responsibility. So society finds some way of kind of quarantining them so that they don't... I mean, these are all uncomfortable problems. I don't know, I can't get into all of the issues here, but we don't want them running a company. We want people of character running a company. And so, in a sense, a board of directors imposes that. You put people on the board who have reputations as people of high-minded people. That's the way it should work. I think the way it usually does work. People are high-minded people who, you'd probably not want to propose some shady deal to. So you want to have regular meetings of these and where you talk about what the company is doing. And these people impose a kind of community standard on what the company is doing. So I'm going to talk about maybe the most important kind of sleazy behavior in a company. It's called tunneling. Tunneling is sneaking away with value, putting it in your own pocket if you work for a company, rather than in the stockholders. The stockholders own the company, they're supposed to get the money. But the employees have never met the stockholders. And they sometimes think, there's a lot of things we can do. Let's do them. And the money is going to come from the stockholders and it's going to somehow end up in our pockets. So I'll give you just examples of tunneling. The company has some asset and it's going to sell it, right? So asset sales. In part of the doing business, how does the company make sure that it gets a good price? Well, if you work for a company and you're in charge of the asset sale, you can tunnel. You say, I'll sell it to my brother-in-law at a really low price, all right? He'll wait a while and then he'll pay me off later, okay? That's hard to detect because how do you know if you are a stockholder? How are you going to find out? That's stealing from the company, right? If you sell it at a non-market price. How does somebody know that? I mean, they can't be the stockholders can't be looking at every deal. If you ever agree to serve on a board, I think you should interpret it as a moral obligation that you have taken on to prevent all of these things, okay? And to make sure that the business is run in a high-minded way. And to remember that your reputation is at stake because you're part of the company. But it's more than that. It's a moral duty. So you have what's called the duty of care as a board member. Duty of care is a duty to act as a reasonable, prudent, rational person would. That means you have to make sure that you're getting the information, you're watching, you're being careful about your obligation as a board member. You are not managing the company. You are watching the management of the company. And you don't follow every detail, but you have to follow enough that you act as a sort of regulator, and you have to know what you're doing. You also have a duty of loyalty. And that's usually interpreted as loyalty to the shareholders. But I wanted to start with an example of a trade group, and that is the New York Stock Exchange, because it's important in history, and it was founded in 1792. In 1792, stockbrokers functioned. We had a stock market in the United States. Of course, it was a small one. The big stock markets then were in Europe. But there was no organization for the U.S. stock market. We had our first stock market crash in 1792, the first American stock market crash. And within 2 months, the stockbrokers set up a trade organization called the New York Stock Exchange. And they met outdoors under a buttonwood tree. So they signed a document called the Buttonwood Agreement. Stockbrokers used to work outdoors. This is even into the 20th century, the so-called American Stock Exchange used to be called the Curb Exchange. That's because they were guys who would stand on the curb outside of the New York Stock Exchange, which had a building, and they would just dicker among themselves and trade. Then they decided they better get a building, and that became the American Stock Exchange, which doesn't exist anymore. It was absorbed by the New York Stock Exchange eventually. But anyway, the stockbrokers in New York got together under the buttonwood tree and signed a historic agreement setting up the stock exchange. And it's been described as an idealistic document about our duties and our ethics. But I found actually the text of the Buttonwood Agreement, and it's really short. So I will read it to you. I'll read you the whole Buttonwood Agreement. We, the subscribers, brokers for the purchase and sale of the public stock, do hereby solemnly promise and pledge ourselves to each other that we will not buy or sell from this day for any person whatsoever any kind of public stock at less than 1/4% commission on the specie value of gold, that we will give preference to each other in our negotiations. period. In testimony, we have set our hands this day, 17th day of May, 1792 in New York. That's the whole Buttonwood Agreement. It sounds like a price-fixing agreement, doesn't it? And excluding other traders. So it sounds like a cartel. Our attitude toward cartels has changed over the years. And there's a couple of important dates I wanted to emphasize. One of them is 1975, and it's May Day. The May Day was May 1st, 1975. In the United States, the government, under the Securities and Exchange Commission, made fixed commissions illegal. Until 1975, the New York Stock Exchange was still following something like their 1792 rule. Anyone who was a member of the New York Stock Exchange had to impose a minimum commission. And then secondly, they could only trade with each other, closing everybody else out. Now, they could justify that because they're closing out the scoundrels, and so that prevents a race to the bottom. But it had another effect. It was creating monopoly profits. And eventually, the Securities and Exchange Commission said, no more. We're going to have competitive commissions. Any effort to fix commissions in a trade group is now illegal. In 75. I think it's interesting, by the way, that the chairman, this is a local interest, the chairman of the SEC, the Securities and Exchange Commission, in 75 was Ray Garrett, a Yale College graduate, and the president of the United States was Gerald Ford, a Yale Law School graduate. So this had a local beginning. But I can't claim, I wasn't lecturing about finance in those days. Incidentally, that also is 1975 is the beginning of the national market system, which Congress created. So that this idea that you only trade with other New York Stock Exchange brokers was ended. Now brokers have an obligation to find the best price for their customers on any exchange. Okay? So what the government really did is it broke the monopoly. And that's why the New York Stock Exchange has faltered since. There's so many competitors now. You've got all these discount brokers. So it hasn't done as well as, if they hadn't made these changes in 75, it wouldn't have done as well. Right now it's about to be taken over by the Deutsche Börse, the German stock exchange. So that's still on, I think, right, that deal? So substantially it was a cartel. In the United Kingdom, it took a little longer, but in 1986, when Margaret Thatcher was Prime Minister, they had what was called the Big Bang. That's the British counterpart to May Day. They deregulated commissions. And again, it had the same effect. It broke the monopoly. So I could go on a lot about trade groups, but I think we see some idea that, incidentally, the New York Stock Exchange, even today, has its own market surveillance unit that looks, it goes through trading records, and it looks for examples of, say, manipulation. And they will track down and find you if they think that something immoral was done. So that even though they had a deregulation of their commissions, they still are doing that. You know, this idea about allowing groups to regulate prices is controversial. Airlines used to have their fares regulated by the what's the U.S. government agency? The airline fares were regulated at high levels, and in those days, airplanes would give you great service because they were competing on service rather than on fares. So it used to be that when you got on an airplane, there were a lot of empty seats because they were scheduling many more flights than needed, and you got great meals, right? But it was expensive, and so if they deregulate, fares come way down. Services, now you're jammed in, shoulder to shoulder, and if you don't like that, you could pay more, but very few people will pay more. So I think on balance it's a good thing to deregulate commissions. And now we have all these websites now that sell on very low commissions. It's a product of deregulation. A product of regulation, regulation that prevents the cartels from forming and closing out competitors who might charge a lower rate. So the third thing I said about local regulation, this is my third category. It used to be that it was a more local phenomenon. I'm particularly thinking of the United States, but I think it was true elsewhere as well. Local banks would be regulated locally by the people who saw them rather than a distant national government. In the United States, until the 1930s, financial regulation was almost exclusively local. The federal government didn't do anything. So we had a bunch of laws called blue sky laws that were put in place by state governments during the Progressive Era. The Progressive Era was from the 1890s to the 1920s. That was an era in U.S. history when a lot of state governments started adding regulation. They did other things like regulate food safety and other business laws. But regarding finance, it was the blue sky laws. Now, I don't know if anyone remembers why they're called blue sky laws, but one interpretation is that there were a lot of salespeople for investments, and some of them would give you an exaggerated sales job they would say, there's no limit to how high the price can go of this stock, nothing but the blue sky above. So that's my story about how they got to be called blue sky laws, but I don't know if there's any agreement on where that name came from. But what state government started to do, and I think the first blue sky law was in the state of Kansas in 1911. It was given some impetus by a book written by William Brandeis called Other People's Money. In 1914, I think it was. That was a book that detailed the scandals of fake securities or dishonest promoters of securities. So it started in Kansas in 1911, but by the 1930s, practically every state had blue sky laws. And they had state regulators that enforced them. But the problem was that they were state laws, and it made it difficult for state governments. There's all these different state governments are trying to regulate an industry which is really national or international in scope. So people could evade the blue sky laws. Now, especially since the telephone became prominent in the 1920s, you could set up a boiler room, so-called, in one state. A boiler room, I think I said this, is you rent the cheapest space for your telephone bank, and you pick the boiler room in the basement of some building, and you put a bunch of people manning the telephones, and they call across state lines. So this confuses the blue sky regulators because it involves two different states. And you call long distance to the other state, and this used to happen a lot. It doesn't happen so much anymore. They would try to sell you on I've got a great stock, it's going to triple in 5 days. If you don't buy it today, it's too late. And they would get people into stocks that were utterly worthless, and it was fraud. And so that made it, the whole progressive movement to regulate securities was of limited success. But it left in place a huge state and local regulatory system that was considered inadequate to the task, but which remains today for the regulation of smaller companies. The next step is the national regulation, which occurred in the United States in the 1930s under the New Deal of President Roosevelt. So for national, notably, in 1934, I mentioned this before, the U.S. government set up the it's actually, let me spell it out, Securities and Exchange Commission. Or SEC, which regulates the larger firm. Practically, any firm that's listed on a stock exchange would be regulated by them. One thing that the SEC does is protects small investors by managing the distinction, I mentioned this before, between public and private securities. So if you want to go public and list your security, the shares of your company on a stock exchange, you have to go through a procedure defined by the SEC called an IPO. That stands for Initial Public Offering. And to do that procedure, you have to follow a system of rules dictated by the SEC that makes it difficult for you to do any shenanigans, any tricks. It creates a level playing field, and the rules are very strict and enforced by the SEC. The SEC allows other companies to remain private, but it has rules about what you have to do to stay private. When you become a public company, you are involved in the public trust. And that you have to, among other things, include all of your documents on sec.gov. But they do allow private companies. And a particularly important category of private company is the so-called hedge fund. A hedge fund is an investment company for wealthy individuals only. And there's, the idea is that small investors need to be protected because they don't know, they don't have expensive advisors and lawyers to tell them what to do. And so lots of controversial things can't be done in funds that are offered to the public. A hedge fund is a fund for these wealthy investors, and the SEC has minimal regulation of them. The Dodd-Frank bill we thought would put more regulation on them, but they're still surviving as largely unregulated organizations. We have something called FASB, which is called the Financial Accounting Standards Board. It's right here in Connecticut. The SEC decided that companies fake their books in too many ways. There's too much funny business going on, and we need to manage this better, but they didn't want to take over completely this as a government function. So the government recognized a industry group called FASB as the arbiter of accounting standards, and FASB is the authority that defines GAAP accounting standards. And GAAP is an acronym for Generally Accepted Accounting Practices. I'm sorry, principles. Generally accepted accounting principles are defined by a private group. And these principles are used on EDGAR, which is the website that the SEC uses to present accounting. So they're in Norwalk, Connecticut, and they have their own website, and you can see how they define accounting standards. I'm running out of time here. I wanted to tell you about another government agency called CIPC. I'm just having too much fun telling you about all these. CIPC is the Securities Investor Protection Corporation, created by the United States Congress in 1970. And it's part of an effort to protect small investors. The CIPC insures your brokerage accounts against losses due to failure of your stockbroker. It corresponds to the FDIC. Did I mention this before? I don't. Maybe I mentioned it briefly, but the FDIC is the company that insures your bank account. CIPC is the company that insures your brokerage account, and it's a government corporation. It has limits on the amount that it insures. It was actually created in 1970 in response. A lot of things happened in response to a crisis. There was a brokerage firm called Goodbody that failed in 1970, just before CIPC was created. A lot of people had their stocks in Goodbody, and they had accounts there, and it looked like they were going to lose it. They held their stocks in street name. Now, I remember telling you about that. So they thought they owned shares, but really Goodbody owned the shares, or they thought Goodbody owned the shares. When Goodbody went under, they ran the risk of losing the shares they thought they owned. So CIPC was created in order to prevent that. Continuing along on the national level, regulation is getting stronger at the national level. I'll talk about two examples, the US, and I'm going to talk about the European Union as if it were a nation. It sort of is a nation. It's an assembly of nations, but it's kind of halfway between national and international. But I'll start with the US. I mentioned that in the 1930s there was a big step up in regulation with the New Deal, creating the Securities and Exchange Commission. The next big regulatory push in the United States occurred last year, in 2010. And we had the Dodd-Frank Act. Christopher Dodd was our own senator from Connecticut. And Barney Frank is the chair of the House Financial Services Committee. I'll just give you a couple of things from the Act. One of them is the Act is really trying to push regulation more to the macro-prudential from the micro-prudential. All this thing about fraudulent activities that milk innocent individuals, that was taken care of by previous legislation. Well, not all of it, some of it was. But the Dodd-Frank creates the Financial Stability Oversight Council, or FSOC. The Financial Stability Oversight Council is designed to worry about too big to fail. They are the regulator that deals with systemic risk. That is, risk that affects the whole system. They are regulating not just to protect the individual from bad activities, from being fooled, but also to protect the whole system. So that's part of Dodd-Frank. The other part I was going to mention is the consumer. I see it two ways: Bureau of Consumer Financial Protection, or Consumer Financial Protection Bureau. So I'm not sure how to write the acronym. It hasn't actually taken form yet. I'll say Bureau of Consumer Financial Protection. This one is a microprudential regulation. I mentioned her before. I think Elizabeth Warren proposed it. She's a Harvard law professor. And what it's going to do is have a government agency that is focused on protecting small investors or borrowers in the mortgage market or the like. Yes, that's right. I can't write always on the blackboard. Thank you. Bureau of Consumer Financial Protection. Okay. Elizabeth Warren pointed out, I said this before, that there's a lot of abusive tactics. Now, other regulators weren't so focused on protecting, say, mortgage borrowers from, or credit card borrowers. And so they were more focused on disclosure and other issues. So the idea in Dodd-Frank is, let's create an agency whose express purpose is protecting the consumer. The idea is that agencies you have to have an agency focused on each problem. And this is a problem that hasn't been dealt with well. I wanted to move to Europe because Europe has had similar legislation also in 2010. So we have the European, okay, I'll write it out, European Supervisory Framework. And that's also 2010. It consists of a number of things. One, the European Systemic Risk Board, which will be in Frankfurt, well, which is. I think they're just getting started. European Systemic Risk Board is the European counterpart to FSOC. All these things are brand new, and so we don't know too much about how they're going to function yet. But it's supposed to worry about too big to fail and about systems, how the whole European economy could collapse if something goes wrong in the future. Then there's the European Banking Authority. These are big steps for Europe because regulation was more done by the individual countries. And the European Banking Authority is in London. And it will impose Europe-wide banking regulations. And then we have ESMA, the European Securities Market Authority, and that's in Paris. And then there is the European Insurance and Occupational Pension Authority, and that's in Frankfurt. Of course, they spread things out across Europe. They don't want to centralize things. So I don't know why Frankfurt got two of them, but somehow that worked. Finally, I want to do international. If I could just have 5 more minutes of your time. International regulation is a problem because people can leave the country that they're in, and it's called offshore. If you don't like the regulations in the United States, there's always the Bahamas, or there's the Cayman Islands, and you can set up your financial organization with the regulator that you please. That's why it's important for international cooperation and regulation, so that all the financial activity doesn't migrate to the cheapest place, or the cheapest in terms of regulatory cost. But I just wanted to give you a few more institutions that are important. One is the Bank for International Settlements. That's in Basel. This is the oldest of my regulators, 1930. Actually, when we get on the international front, they don't really have authority anymore. They can't impose on anyone, but they can suggest things. So the BIS is a bank that has as members heads of, I think it's 57 central banks, and they meet regularly in Basel to discuss monetary policy. So what comes out of these meetings is suggestions about how to run a central bank. And it has real impact, even though it doesn't have the force of law. Then I wanted to mention the Basel Committee, also in the same city. You notice these are in Switzerland. That's because by long standing it's been a neutral country, and it has such a long tradition of neutrality. So it seems to be the place to set up a lot of international organizations. This was created in 1974, and it issues suggested bank regulation. Basel I was in 1988. That was their first set of recommendations. Basel II was in 2004. And obviously Basel II wasn't successful because we had a huge banking crisis. So we've had Basel III. I'll come back to these in well, it's been going on for years. It was finally approved, Basel III, in 2010. Then I wanted to talk about the G6. Going back to the 1970s, the finance ministers in 6 major countries met together. The countries were France, Germany, Italy, Japan, United States, UK. In 1976, they added Canada, and it became the G7 countries. So that's Canada, France, Germany, Italy, US, UK. Who am I missing? Japan, yes, Japan. So these seem to be the most financially prominent countries at the time, and their finance ministers got together and thought about what the country should do, and it coordinated financial regulation somewhat. This expanded notably. I'm just about done now. In 2008, the world is changing, and there was resentment that these countries represent overwhelmingly Europe and the US, or the North America. We created the G20 countries in 2008. And I don't have the whole list, but it notably adds China and India, and it adds other developing countries. It now represents most of the world.